Here, this is the evolution of payments and financial technology innovations. My name is Ravi Viswanathan. I'm a general partner in NEA. We're a global venture capital firm with offices here and Washington, D.C., as well as in Asia. We invest in technology and life sciences. We have a big effort in fintech and payments. So I'm excited to be on this panel. We're also spending more and more time in Israel, so another reason for me to be excited to be here. So we have a great panel. If you think about fintech and payments, there's lots of reactions, but one thing for certain I think is it's a very complicated ecosystem. There's lots of players, and each one has constituencies, and there's also a regulatory framework overlaying it. But this panel actually has folks from all parts of the ecosystem, so I'm just going to briefly go through these folks, and then we'll have each of them spend a minute or two. So we have directly to my left, Craig Stuart at Wells Fargo. To his left, Marcelo Perez at Merchant eSolutions, Guy Goldstein at Intuit, Steve Waterhouse at the end of Pantera Capital, and Patrick Gauthier at eBay. And so why don't we take a couple of minutes, each of you just introduce yourselves, introduce your business, and where your company fits into the fintech ecosystem. Go ahead, Craig.
Sure. Okay. So I've been at Wells Fargo for about 14 years here in San Francisco, working in that time in product development, product strategy. Now I'm in a strategy role for the overall corporate cash management business. So where we fit in, obviously we're a large, diversified financial services company covering all sectors of the economy and customers. Where I would say I fit in at the moment is looking at payments as an opportunity to facilitate the business that our customers are doing. So we support, the line of business I'm with specifically focuses on the depository and payments, the accounts receivable, accounts payables, treasury, excess liquidity, and liquidity risk management services for corporates. Within that space, right, there's ever more parties involved, right? More and more from technology, certainly a number of processors, certainly a lot of bank-to-bank counterparty activity. So within that, I think we see the ecosystem changing fairly rapidly. But again, our focus, in particular the area that I'm in, is on supporting the operating needs of large corporations.
Okay, I represent Cielo. Cielo is a merchant acquirer, headquartered in Sao Paulo, Brazil. We have a subsidiary here in the US called Merchant eSolutions that we acquired 2 years ago. So what we do in Brazil is the same that we do here in the US. We connect merchants with the payment networks. We process their payments. So in total, we process around $320 billion in volume. We have almost 2 million merchants, both in Brazil total and here in the US. This company has been around for a long time. It went public in 2009, which Cielo is still the largest IPO in the history of Brazil. Lots of value captured in payments that went out, and it's been a very successful company since then, both in terms of market cap and growth. Our presence in the US is small, but I mean, we are based here in Silicon Valley, in Redwood City, and we are focused pretty much here on card not present transaction, e-commerce, B2B, and you know, for us, I heard the person in the panel before saying that Brazilians want to be big in Brazil. Well, it's not our case. I mean, we came here. We are looking at everything that's going on. This is a very exciting moment for the industry, very exciting place to be. So we are trying to learn and absorb everything that is happening in this ecosystem, and also continue doing the same thing that we've done because it's our core business.
I'm Guy. I was the founder and CEO of a company called Check. We recently were acquired by Intuit, and now I'm running this business in Intuit. And basically what we're doing in this business unit within Intuit is mobile payments. And we have a product that allows consumers to track and manage all their finance and also to do payments from their mobile phone. And together, our business and the existing consumer business at Intuit is more than 20 million consumers in the US that are using our product.
I'm Patrick Gauthier. I work at PayPal. I manage a business unit that has a primary focus on means to extend the services we offer to retailers and monetizing and engaging our customer base. Because what you may not realize is that PayPal has a customer base that is significantly larger than Amex's. I've been in the payments industry for longer than I'd care to say, always working a little bit on the edge. For a long time as the head of innovation at a prior company, my job was to take the no out of innovation because the payments industry was very change averse. I think we're at an interesting time, partly because new technologies are increasingly enabling new entrants to come, and partly also because we can redefine the suite of what we're offering, extend not just beyond checkout, but to think through the different stages of the purchase cycle, at when we can actually do something much more than getting payments, but which is reducing the distance between the time that the consumer makes the decision to buy and the time the transaction is actually complete. And that's really what we're after, reducing that distance.
Hi, my name's Steve Waterhouse. I'm a partner at Pantera Capital. We're an investment firm that's focused on investing in the Bitcoin ecosystem. We are the largest institutional holder of Bitcoin, and also have a venture fund that has 14 portfolio companies in it, which range from exchanges all the way through to consumer applications.
So this is great. Thanks, guys. So I'm going to ask a question that's a little bit more generic, and then we'll get into the meat of the session. The first question is, because each of you plays in a very important but different part of the ecosystem, what key trends or drivers are you guys grappling with, excited about, worried about? It's a toss-up. So why don't we start with you, Steve?
Okay. Well, Bitcoin, as you probably, if you've read the newspaper in the last couple of years, has a reputation of being volatile and sometimes associated with the slightly sketchier parts of the internet. If you don't remember, the Silk Road was an online drug marketplace where the payment mechanism was Bitcoin. So we've definitely, as a community and obviously as an investor, we're very conscious of this. We have had some interesting press over this period. The Japanese exchange, Mt. Gox, melted down in February, and people are still looking for some of the Bitcoins that some people we know say they found. But there's a lot of murky kind of things going on in this space. And this is very typical of sort of early emergent technologies, is you have, on the internet, the very first people getting into it, apart from the geeks, were, slightly sketchier porn kind of things. But, porn is a part of the internet now, but it's not all of the internet. And when we're working with regulators, we spend a lot of time talking to the regulators now. One of the big tendencies is for the regulators to try and over-regulate what comes along. So when you do that, often you can squash a new technology, as we were just talking about from PayPal. They're seeing a lot of new technologies coming out. But also you can create a situation where you push people who are valuing things like fast transaction speed and aspects of anonymity and lower transaction fees into the same group as the same people who want to move money around the world for terrorism financing. So we're spending a lot of time working with regulators to educate them on that. That's one of our biggest concerns.
And we're going to spend some more time on Bitcoin, but that's interesting you say, because the one issue is that use case. Do you have a sense for when it'll topple from pornography, terrorism, illicit activities to something that's more mainstream? Is this a 3-year event, 5-year?
Well, I certainly wouldn't say that the majority of, or even a significant component is either of those two use cases yet. The majority of Bitcoin that's used right now is speculative. People buy it and hold it and trade it. The other use case for Bitcoin right now is Bitcoin. Bitcoin's a minted using a process called mining. Essentially, the mining is running the distributed network that makes Bitcoin possible to be used. Essentially, Bitcoin is a peer-to-peer network rather than a centralized network for payment transactions. So most of the time, Bitcoin is used right now as miners mining the Bitcoin and then pumping the Bitcoin out into either buying things online or buying more mining equipment. But increasingly, we're seeing a lot of e-commerce merchants, including PayPal recently, to going online and accepting Bitcoin. We see this just essentially as building out the ecosystem building out the kind of plumbing for Bitcoin. We're personally most excited about things that you can do with Bitcoin that you couldn't do otherwise. One example of that is micropayments. If you're going to move outside of the walled gardens of Apple and Google and Amazon and actually have content produced by people and paid for without using the Apple payment network or the Google payment network, you're going to need something like Bitcoin to be able to allow that to happen. The other area we're looking at is the developing world, where we believe that technology like Bitcoin will allow people to leapfrog from being unbanked to having bank accounts, but not in the conventional sense of what we think of as bank account today.
Patrick?
As you pointed out, we're from different part of the ecosystem, so I'm observing different things. For us, the major trend that has been sort of shaping up and is accelerating is the fact that commerce is becoming intensely connected. So this has two effects on what we do. There's both a convergence and a divergence of a bunch of stuff. So the convergence is within the different verticals that payment used to have. PayPal used to be payment online. You had people who were doing payment on mobile, usually telcos with walled gardens, and then you had payment in the physical realm. And all of this is massively and rapidly converging and becoming connected and running on single stacks, connecting to a bunch of services on the cloud. And yet at the same time, you also have divergence. So the components that constitutes payment, which are identification, authentication, authorization, settlement, and reporting and compliance and so on, these steps are potentially on the verge of being componentized and spread apart. Identity as a service is really what an online wallet is. And you're going to see, I think, other components coming about. So the entire map is kind of recombining itself, taking those components which were neatly stacked by channel and completely rearranging them and often connecting them with other services that are part of the act of buying. Because remember, mere mortals, I know we're above that here, but mere mortals rarely wake up in the morning thinking, today I want to pay for something. Usually they wake up in the morning saying, today I want to buy something or I want to achieve something. And the payments is really an embedded portion of the overall flow that people go through, which is increasingly indeed just that, a flow, not a set of steps.
Okay.
I think there's two trends, main trends. One is, I think, and excuse me, my colleague banker, that technology companies are taking over the banks. And I think that we see a lot of innovation and a lot of progress from technology companies that's starting to take pieces of the banks. And over time, the banks will be either like the, I don't know, carriers of the world, or worse, the trains of the world. Depends how far we'll go with the managing the money. And you can see it in investment. There's a new companies that are doing investment and do it electronically and much easily. We can see it in lending and loans. There's a lot of technology companies that are coming in lending and loans and do it in a much better way with more technology. We see it in payments happening. So slowly but surely we start to see it in many, many other companies that are taking pieces of the banks, running in a much cheaper cost structure with the better services that are better for the consumers. If you look today just on the App Store and look on the star reviews of the bank application versus the star reviews of the technology companies, the banks are somewhere between 2 and 3 stars reviews, and the technology companies are all in 4.5 to 5-star reviews. And at the end, the consumer wants good service. So I think this is one trend that's happening and in the fintech. And the second thing is mobile payment. So everything is moving to the mobile, and the wallet is moving to the mobile as well. And consumer will do other payments using their phone in the future. And this one changed the behavior of the consumer, but I think after the consumer will change the behavior and will take some time, even the infrastructure might change over time. Because we don't need all this complex infrastructure that is built today, and they can do things that are much simpler. And Bitcoin is one of the examples how you can do something way better in moving money and running a ledger.
Great.
The point that I would like to, that it's, to me, I also been working in payments for a long time. And is how the payment ecosystem that we are talking about is expanding, right? Is growing. Today, if you want to play in that value chain, even if you are a new entrant or technology company, is how many decisions you have to make is where you want to play. That is getting more complex. That value chain is being fragmented, faster and faster that I've seen before, right? And that is accelerating. So now, any technology-driven company can play in payments in some way. That wasn't the case, 5, 10 years ago. The other thing that is also interesting to see is there is a shift also on the attention about the industry itself. 10 years ago, probably people were looking at emerging markets. The money was going to economies based only on growth. And countries like China, Russia, e-commerce was mostly something that was a European thing and how they developed. That shifted totally to the US now. I mean, the last 2-3 years, all the innovation is happening here in the US. All the money is flowing back to the US. It's not only the VCs. I'm talking about people from outside, and we are a case of that. So we could have invested money in country or in other countries. We decided to come to the US because it's where the innovation is taking place, is where the market is happening. This market is growing more than it should, if you think. With a mature economy, people are basically an appetite for mobile, an appetite for payments, and all these keywords, Bitcoin, Apple Pay, everything, it's happening here. And for us that we live here, seems like an obvious thing, but when you go out of the US, that is not necessarily happening outside. So to me, that is a very, very interesting shift of things, how the US regain kind of the control and the spotlight on payments / technology in general.
Great.
So I would agree, and I appreciate your comments, Guy. In the area of payments, it's true. I think that technology is absolutely enabling a lot of entrants into the ecosystem, and I do think the ecosystem, as you say, Marcelo, is it's expanding and it's getting crowded, right? And we could maybe talk at some point about how there may be a lot of mouths to feed from that. So the three major drivers of change that I see are security, right, and the impact of if you're in the financial ecosystem of not having your security nailed down, the impact is much greater than it used to be in a brick and mortar world. The second would be compliance and the increased interest in the regulators. Maybe it's more the regulatory environment, right? So these are both external factors, right, to the side of our core business or anyone's core business. If you're in financial services, which, and their interest, it goes across the board to a lot of different areas, right? Money laundering, systemic risk, the ability to apply security. And interestingly, those are areas where I don't see the technology companies trying to eat our lunch at all. But in the third, in customer demand, right, this is an area where technology is enabling so many new mediums and because it can be componentized and disaggregated, manners and mechanisms of customer engagement. So we do see, and I think it's also because in a digital world, right, digital information, whether it's the payment information or other aspects of the buying activity or commerce, right, can be sort of repackaged and recombined, right, that this is an area where the fundamental back-end processing of what was financial services becomes certainly less glamorous, and there's also this opportunity, right, to sort of grow an additional area of the business model, and I think that's absolutely what we're seeing, and it's driven by consumers' belief that anything can be delivered in an anytime, anywhere world, right? That's the promise of mobile, I think. and you know, this persistent immersive experience. So that's largely what we're seeing. In the corporate space, that tends to trend a little bit more to the consumer segment, right? In the corporate space, we do find a lot of trends, but I think that this is still enabling opportunities for new entrants in the technology space, non-traditional players, right? Their focus tends to be a little bit more or less an immersive experience that the digital space enables these days, and more around traditional responding to competitive pressures. How can they cut costs, become more efficient, automate their processes, right? And there's still, in the business, in the corporate space, there's still a lot of friction around what it takes to actually manage payments. So the sort of, the root causes of customer demand are a little different between the segments, but the opportunities for new entrants, I think, are fairly similar.
That's great. So shifting gears a little bit, if you think about technology, just to use that word ecosystem, decades ago, you had the server and hardware guys, you had the software guys, you had the services guys, and ne'er the twain shall meet. Now, with Google vertically integrating payments, Apple Pay with their announcement a few weeks ago, and eBay, PayPal divesting, you know, I'd love to get, and maybe Patrick, since you're at eBay, I'd love to get your take on the PayPal eBay breakup, but also how we should be viewing the tech giants that are now becoming fintech and payment powerhouses.
Well, first, I'm not going to comment on the eBay PayPal split simply because that's a material event. And so what you're going to hear from me is simply that as the market evolves and what we're solving for is becoming somewhat different, but there are synergies between the two companies, and we believe that we can affect those synergies in operating in a different way than we did in the past. 2008, when I joined PayPal, the question was asked. At the time, we thought you could not, and now we think we can. So the relationship between eBay and PayPal is very strong at a couple levels. First of all, we do acquire a lot of new customers from eBay. And this matters. Anybody who's run a payments business knows that the cost of acquisition of a customer, in particular as you have to run that parallel with the cost of acquisition of merchant, can be a daunting task. Just ask Square and Square Wallet. Second thing is our data set between PayPal and eBay is a fairly different and very complementary data set. So on eBay, we know what people browse and what they buy on a product level. And at PayPal, we know the transactions they do on a merchant level outside of eBay. When you put those two things together, you start to get some interesting perspective on top of funnel and bottom of funnel behaviors, which, the most obvious is lots of people say, oh, and then do what the business that I run, digital offers and things like that, demand generation. But there's many other applications. For risk management, for instance, it's very powerful. Right? If you see something is out of pattern, you can, and risk management from a consumer front, but also from a seller front as well.
And so the data in both is already getting integrated?
Yeah, the data, so we're one company, so we use absolutely, like in risk management decisions, we use data both from the eBay data set and the PayPal data set. So there's synergies are there, but how you execute on synergies can change. I think what the way we look at things moving forward is lots of people entering payments, but the core business of payment, to echo a little bit what was just said, there are a few things that continue to be hard nuts to crack. And one of them is compliance. And the factor is, the way compliance, it's an ever-extending pool of things. Another one is indeed risk management. There are very few people that really understand risk management. Again, ask folks at Square, right? They've been losing their shirt now for 5 years on fraud issues, both on merchant fraud as well as consumer fraud, because it's just plain hard. It is plain hard to take effective decisions on a real-time basis in the flow of the transaction, and scale it to the point where you make money at it on a repeated basis. So we think that payments. The interesting thing about payments is that, and especially in a world where everything gets connected, is suddenly you're starting to see electronic payments in a bunch of places where you didn't see it before, right? The poster child for me is Uber. you can only do Uber. I mean, this is the quintessential e-commerce, right? At the beginning of e-commerce, we used to say, it was at Visa at the time, it's like, oh, well, nobody can put a check or cash into the machine, and that's why eBay bought PayPal. Well, in a connected world, where really the payment has to be totally subsumed to the overall experience, and that the payment is implicitly or explicitly authorized behind the scene on the following a step of a positive identification of the person, the device, and so on, and B, on a description of the transaction even before it's been fully consumed. There's a very different way to consume payment than I go to the store, I fill in the cart, I scan the card, I pay. It's a very, very different way to think of payment. And so this both sort of convergence and divergence building components out of payments, I think is opening a number of those use cases. The fascinating thing from our standpoint is that it is enabling some of the commerce disruptors, such as Ubers and many others, because we're bringing to them pieces of infrastructure and ways to execute that were really not possible just 5 years ago. That 5 years ago, somebody would have had to build a back end to deal with compliance, risk management, et cetera, which would have taken a boatload of capital to get started with. And as we bring payment as a service, or everything PayPal as a service, to a lot of those commerce disruptors, we think we're an accelerator. And we don't just think, we're convinced of that. That's why we spent a little less than $1 billion in Braintree, because for us it was also about
Thank you for
accelerating
that, by the
our
way.
acceleration. Yeah, I know you would be happy.
That's great. Thanks, Patrick. So you talked about Square. 5 years ago, there was a statistic that $900 million was raised in fintech companies. That number last year was $3 billion. So pretty massive increase. So on the spectrum, and this is just open up to anyone who wants to take this question, the spectrum of it is a bubble, you have too much money going into these companies, to we are in a new era of innovation with unbelievable disruptors and technologies getting formed and companies getting created. How do you guys think about that, and where are you on that spectrum? Anyone?
I can. So the market is huge. Like, the banks are making a lot of money, and there's a lot of opportunity in the market. And I think that VCs and companies see it, and they see that it's hard for the banks that today run the system to execute as fast as the innovating companies and the technology companies. And they see that potentially the wealth will move from the banks to these technology companies. And I think that's the reason that people invest in fintech. Having said it, it takes time. It's not like Facebook. Like, people need to change behavior. And the fact that Apple is getting into the space and Google entered into the space and PayPal is already in this space is really helping the space to get more credibility and grow faster. I want to comment on your two comments. It's how to do risk and it's how to do compliance. It's hard, but the most important thing is to get value to the consumers. And if a company builds value to the consumers and able to get consumers and get them to use them, risk and compliance is just checkmark that they need to do. No, it's not something that you cannot go with it. PayPal started without risk management and built it.
I'm probably where Patrick is.
But nowadays,
shaking
I'm
my
shaking
head.
my head because nowadays, it's like, okay, there are plenty of data that shows if you go down this path, you will have a long vacation. Let's be very clear. There are people in companies, in very reputable companies, and very knowledgeable companies that have paid billion-dollar fines, billion-dollar-plus fines for being cavalier about compliance, and people who have gone to jail. That's the world we live in post 9/11. So that's a bit of the difference from when the time PayPal started to now, and the importance of compliance and the complexity of compliance in a global world. If you're doing connected commerce, you're doing cross-border, is not going down. And so compliance can be definitely helped with tools and whatnot. But I wish it was easier. But the fact of the matter is, it's not. And you can't be cavalier about it unless you want to have a long vacation.
I think the analogy I would use is, how many people remember Cosmo or Urban Fetch? those that lived in New York 15 years ago. That was an example of a wonderful experience. I would order a Ben & Jerry's yogurt, frozen yogurt for $3. They would come with a yogurt, a free T-shirt, a pen, a bag, and the company is gone. So that's where there is an example of delighting consumers and going out of business. I actually agree with Patrick. You can do that, but in payments, if you don't get underwriting, you're done. So, but it's an interesting.
So you get underwriting, you get the compliance. It's not impossible.
Yeah, I think on compliance rate from the regulatory perspective, there's a couple dynamics going on. One is that the government has, whether it's concerns or an agenda, but the banks are an industry where regulation already exists from a number of different agencies, right? There's a structure in place for law enforcement to leverage that to achieve the ends that they need to achieve their goals, right? So that this is a challenge, right? This is not something that the bank just needs to be good at, right? This is something they need to be respond to, an external actor in the ecosystem who has some real power. I guess from the perspective of the value, so I mean, it is a relatively high investment of capabilities, but I think that it's manageable if you have a good business model and you're delighting your customers in theory, right? It should be or could be. I think the challenge maybe in the financial services space to being able to continue to execute that is one, the business model needs to anticipate further disruptive technologies about where customer behavior will go, and that seems difficult to predict. And so that may shake, the future fortunes of some large companies who've approached the financial services space from the technology side of it. The other is that day-to-day execution, because I actually totally agree, in terms of standing up a new business, the banks are, for a number of legacy reasons, regulation being just one of them, right? But having a legacy business, it's not easy to be nimble enough to compute. So executing on a new idea, you're right. But executing day to day, there's a very high standard of reliability that customers put on the day-to-day execution of financial services that if you don't meet it, right, you can fall out of favor very quickly. I think we all put up with customer dissatisfaction from a lot of other service providers that we would never tolerate from financial services. So, if you're going to grow and continue to be large and sustain those valuations, I'm not saying it can't be managed and mastered, but it requires a certain amount of investment in capability and discipline.
Marcelo, do you have a comment?
Yeah, just to follow up on that, because I'm going back to your valuation question. Yeah, the industry is talking about how high these multiples are, right? And the question sometimes I ask myself, is the pool of revenues growing that justify more value or valuation? A good example of what happened is when you look at what happened with Apple Pay, they're basically getting a piece of the value chain and that revenues out of somebody else. So there's no new creation of a revenue stream. Somebody else is giving up to make room for these guys to get in. There is an upside, maybe, right? But for now, this is what happens. So when you think about valuations, again, it's people probably are buying the things that they don't have. So you're not buying volume, you're buying that piece of technology or development that is too hard to do your own because you don't have time, you don't have the resources. So you're getting that thing that you have to attach to your business, and this is what people are basically paying for. How long that is going to be sustainable, honestly, I don't know. But it's an interesting process because the faster this happens, probably the faster this ends up falling apart.
So just building on the commerce theme, Steve, I wanted to ask a Bitcoin question. So I would love to get your take on whether you think the ultimate use case or an ultimate use case for Bitcoin is commerce, or whether you think the real value is in the blockchain, the bottom of the stack where there's real fundamental IP in the communication protocol.
Yes, it's a good question. I think the analogy a number of people make with Bitcoin is back towards the internet. It's very, very early in the development cycle for this technology. And I think similar to the beginning of the web, where there was a huge amount of hype around consumer applications, and really the dot-com bubble was very much driven by things like pets.com, which very much consumer focused. And it wasn't until much later that, like really now, that we're seeing real compelling consumer applications on the internet that really change the way people live and communicate and move around. And the backstory of the internet was the business to business, the infrastructure. That's really where people made a lot of money. And I think the same thing's happening right now with Bitcoin. There's a lot of focus on, is Bitcoin going to replace a fiat currency, or is it going to be the thing that you wake up in the morning and go buy coffee with Bitcoin? And I don't really think that's the case. I think that we're in the same kind of hype cycle. People get onto new technology and they wonder how it's going to change their lives. But the real way it's starting to change people's lives, for example, we're investing in a company that's focusing on the UK-Kenya remittance corridor. And so essentially moving money from Kenyans who are living in the UK working and moving money back to their families. And remittance is a very, very interesting worldwide social problem, which is the amount of money that is captured by the intermediaries in moving money from people who really can't afford to lose that much of it and are working very hard to send it to their families. And the economic and social benefits of families that receive remittance versus otherwise is dramatic. I mean, we're talking about really developing the developing world. And so in this case, with Bitcoin, we're focusing on Kenya because in Kenya they already have essentially this virtual currency. It's called M-Pesa. It originally started with people trading cell phone minutes using scratch pads, and then the phones. Vodafone grabbed this technology with a company called Safaricom and said, "Hey, we're going to try and roll this out across Kenya." So Kenya actually has, and initially what happened with M-Pesa was people would get M-Pesa on their phone and then they'd go and trade it out into Kenyan shillings, and then they'd have shillings and they'd go buy things with it. But as the use of it grew, more things became priced in M-Pesa, and you'd be able to use this thing really as a transactional currency. We're seeing the same thing happening with Bitcoin right now, is that people get Bitcoin, they trade out of Bitcoin, or they speculate on Bitcoin, they hype it in Bitcoin. But you don't take Bitcoin and then go buy something else. I think what we're going to see is a couple of things. One is the developing world and the movement of currency through into the developing world we think it'll start to use Bitcoin as sort of a transport protocol. So instead of the conventional intermediary banking system and cross-border banking transactions, you start seeing companies and also movement from one part of the world to another. There are some companies we're looking at right now which are actually looking at business-to-business transfers within the same company, just like moving money across the world and being able to do it more rapidly and with lower cost. So if you start thinking about this thing as an infrastructure play, then suddenly all of this kind of hype around the currency and is it going to replace this and replace that, it starts looking somewhat like a red herring. 10 years out, I don't know, maybe it's another global currency, but we're looking at this thing as an infrastructure play for right now.
Just one or two more questions. I want to open it up for Q&A here. Craig, question for you. You talked a little bit about payments, but if you look at innovation that's happening outside of the banks, lending platforms getting created, asset management platforms getting created, how Wells Fargo, take you as an example, and if you have insight in other banks, how are you all viewing? Are you viewing it as that's great, that just enhances the market for us, or we're threatened by it, or you know what, once these get to scale, it's something we can partner with or even acquire? How are you guys thinking about that?
Well, I think those are all potential ways to think about it and potential outcomes, right? The innovation in the space is good, right? I mean, and it is an ecosystem, and many of the technology companies still need some more traditional services on the back end. Now that may be driving in a long-term horizon towards more commodity play for the existing banks. So that's a risk, right? Or that's a strategic implication, right? That is potentially a threat of some sorts. But on the other hand, right, there's a lot of business to earn right now from these companies, right, who need a provider of certain back-end financial services. There is also partnering opportunities either today or in the future if they grow to scale. There's a huge learning curve, right, that we also enjoy. And I mean, for ROI benefit, I suppose, right, or business development effort, but also because, I mean, we're interested in pushing the space as well, right? I mean, we have an interest in reducing friction. So I think all of these are aspects of how we view the emerging technologies. And some of these spaces, like, well, I was thinking more in trading or in lending, right? I think that, well, let me take the lending, right? Peer-to-peer lending, I think, or peer-to-peer payments, right? I think one thing that we see that the digital space is enabling and changing in society and how people interact with each other is these communities. And these communities become sort of forums for, like interested hobbies but by extension or maybe independently, things like crowdfunding, right? So the community nature of social media, or social media being one sort of, dynamic of that, is certainly an opportunity for a new space for financial services. The flip side of that is that counterparty risk or underwriting, right, is a discipline that tends to be best mastered by making mistakes over time and having the wherewithal to survive them. So I don't know how that will play out exactly, right? Whether they'll be able to generate the scale on their own or without a financial services partner. But I think there are a lot of ways that it could go, right? A lot of opportunities.
Great. Any other comments before we open up the floor? Let's open up the floor. Any questions?
Just an anecdote, if I may. So I'm an attorney with a global law firm, and I provide a lot of financial services counseling. And to the sort of the discussion that was going on between technology and banking, so I can give you a real-life example where I was counseling an Israeli startup that was looking to do some very interesting things in the currency exchange space. Basically marry currency exchange and social media, social networking. And the idea was brilliant, and it was really very much pushing the envelope. But then when I sat down, and they came to me and they said, okay, how do we do this? We've kind of whiteboarded it. Now tell us what's kosher, what's not kosher, what we can do, what we can't do. And I said, okay, we'll look at the US, then we'll look at the EU. And when I went through, for example, the MSB regulations, both on a federal level and on a state level, and I said, listen, let's assume you're not a bank. Because if you are a bank, then it's really complex. But let's assume you're just a traditional MSB. And I went through all the state regulations, like their jaw hit the floor. And then when I said, okay, now let's look at the EU, again, they had the exact same experience. And so here's a company that wants to do payment processing, that actually wants to move money from person A to person B, and wants to do it legally. And the conclusion we reached at the end of the day was either be a technology company and license the technology to a bank that already has the regulations and the licenses and the framework in place, or go out and raise a chunk of money if you really want to do this properly. But you can't, in the environment we live in today, and this is maybe people in the room have a different opinion, and maybe the panel has a different opinion. I think it's very difficult for a startup to launch a true financial services business today that can actually move money from one place to another and do it legally and properly and safely.
Yeah, that's a great comment. I think if you looked at that data, the 800 million to 3 billion, a good chunk of that 3 billion was for companies trying to do that. And to build on your anecdote, we're an investor in a company called Zoom, which is money transfer, all of you know it. And it IPO'd, and we did very well. But I remember 8 years ago when we found out, you had to have licenses with every state and park money with every state. And so this thing went from a technology startup, and you didn't have to park a lot, but still, just blocking and tackling 50 states, other geographies, it was mind-numbing. So those are some pretty dark days. So I think that's a very, very good point.
It's worse today. 8 years ago, before 9/11, before a lot of the new regulatory reforms were put in place, it was much easier to do. Now, it's probably 3 or 4 times as hard.
Yeah, we have some experience with that. We have some experience with that. A lot of the Bitcoin companies are doing that. Thanks. Doing that, in the US, and I have a company in Europe doing the same thing. Europe's actually a little bit easier than the US because you can theoretically, if you get it right, you can passport a license from one country to others. But you have to get the right kind of license to do that. the US is a slog, and the companies I know have been doing this for about a year and a half now and still don't have, the big states, and Bitcoin's even more complex because guys in New York are trying to make all sorts of funky rules for us. But yeah, it's a pretty big deal. You can't even buy somebody with the licenses because then you've got to change your control issue. But it's money, right? People are kind of freaked out by it.
Yeah, I think that's right. It's money, and people are concerned about being able to know where it's going and make sure it doesn't get places or to people who may fund malicious activities with it. I think, in the U.S., right, the history of states and federalism and all that is too long a story. I think it complicates things for a lot of business growth. But I do think there are still opportunities. I mean, that's frustrating, right, in that example, right? But back to my earlier comments and building on what Guy said, right? I mean, there are companies building, what sometimes we've referred to as sort of synthetic banks on the back of, the underlying, pushing to the background the traditional banks and providing services at a sort of easier user experience, customer experience, and improving on that. So I think there are those opportunities. I also think that, with regard to Bitcoin, I mean, I agree with the comments about the blockchain, but I think that digital wallets and the digitization of money and everything else, right? At least maybe initially it would be easier in a closed loop, but it's going to enable alternate units of value, right? It's already doing that with large retailers, right? And I don't know whether it'll be Bitcoin per se or something else, but I think this sort of alternate union of value, at least initially in a closed loop, right, which may sort of contain some of the money laundering, right, that an open loop model would cause concern about is an opportunity that we haven't really seen blossom yet. But I think, Apple Pay and some other things and other units of value might be the beginnings of something interesting.
There's something, however, here in the Silicon Valley that we tend to forget because we lean in, we're early adopters, a bunch of things. The velocity of ideas here is phenomenal. It's part of the strength of this place and some of the things happening in Israel and a few other tech centers around the world. The real world is slightly different. Okay, and I'm going to use a very practical example.
It is?
For almost a decade after the introduction of the euro in France, I happen to be French, people would see a price in euro, convert in their head to French francs, decide whether or not they wanted to buy it, and then conduct the transaction. So my point is, there are certain things when it comes to consumer behavior change that do take time, and that the Silicon Valley and tech centers can sometimes get slightly ahead of its skis. That's usually, referring to valuation and things like that, that's usually when dumb money gets caught, and with their pants down, because things take time. So there's no doubt that my kids will use their mobile phone differently than I do, including to buy and to pay for stuff. But for now, their economic power in the system, being just graduated from college or high school, is about this big. It's going to be 20 years, whether between now and the time when they are a major force when it comes to consumer retail, whether it's retail banking or retail commerce and so on. And we should never forget about that component, time. 9 women in a month do not a baby make, no matter how hard you want to try.
That's a great comment. But, just let me offer a different point of view, and I'd love for you to pick at it. If you look at M-Pace as a great example, decades ago, there would be a cadence to innovation here, and the developing world would be far slower. What we're seeing in India and China, Southeast Asia, Africa, there's not infrastructure, so they're leapfrogging, right? So smartphones, the sophistication curve has been accelerated there. And so, while I totally agree that, it's going to take time, I guess the only data we've seen, one data point that would disagree with that is the fact that just the explosion and what people are doing.
So I don't necessarily disagree with you. I think, going back to, hey, this is the place where transistors happen to be, right? So you have a potential well, right? So if the energy to get out of the potential well is high enough, okay, so what does that mean in terms of consumer? M-Pesa. The alternative before M-Pesa, if I wanted to send somebody some money it was the case with Fundamo in South Africa, is I would stick the bills in an envelope, give it to a taxi driver, and hope it would make it all the way there, and with a cut of less than 30%. That is one heck of a powerful incentive. Yeah. And the problem is, today, I think in a lot of the developed countries, a lot of the new technology we come out with, especially when it is related specifically to payment, do not have necessarily that acceleration, that energy. It's when you look into the commerce component, in my Uber example, right? Who does not like to leave the car and having skipped the episode of, okay, I'm taking out there, I'm all in the back and so on, and oh gee, did I forget something? No. Here, in case of Uber, just step out, you're done, right? So there are commerce experiences where you're going to get that energy to change, but on some of the core things, right, like buying your milk and your eggs at the local supermarket, that transformation is not powerful enough to really get people to get out of their comfort zone.
Yeah, I think that's a great point. Swiping a credit card is really not that difficult at a lot of point of sale experiences. And if you look at Starbucks, right, it's, I believe, driven, and it's been phenomenally successful, right? I'm sure we know the metrics, but by the loyalty, right? So there's these, or rewards, right? And I do think that that's absolutely right? It's going to take some other behavior shifts around, as you say, the context of how the payment's taking place or what other sort of, information gets associated with it and aggregated and to enhance the experience.
I don't know.
I also think
I think your wallet is over. I think it's just your phone. I think it's just your phone. Your phone is going to be it, and it's going to happen faster than we realize. And you look back, and does anyone remember when the first app came out on the App Store? 2008. It's not very long ago, and since then we've had a whole bunch of apps that completely change.
It needs
people's lives.
longer battery life.
Yeah, they both do, right?
I don't mean the mic. I mean the
phones,
phone.
Yeah.
To be your wallet.
Everything needs longer battery
I
life.
think that it takes time, but there'll be a tipping point, and then it will accelerate. It's not going to be a gradual. We'll get to a tipping point, and we might be very close to it. So it's not that it's going to be 20 years. Something will happen, and then there's a social acceptance, and everybody will use it.
Well, there's also, there's a huge network effect that payments require, right? And you've got sort of different kinds of parties on either end of the transaction. And I do think that the timing is very good for the digital wallet because a lot of merchants are going to need to upgrade their terminals, right? I'm talking about the proximity payments. Baking it in on the apps for m-commerce or whatever, I think is different, maybe more straightforward. But on the point of sale, maybe there's some critical mass of activities, right? There's also these utilities, right, like bioauthentication, which may actually reduce fraud. There could be a couple, not that I think a lot of consumers are actually worried about fraud, but, except getting a new card in the mail. But, yeah, I think, we might have a good storm of combined dynamics, but I don't know when that tipping point will happen, right? Adoption is still a tough thing to predict.
Great, guys. I think we're out of time. Please join me in thanking our panelists.